The US bond yields slid back overnight from their highs for the week on hope tonight's PCE inflation figures will allow the Fed to cut at least once this year. New Zealand's new government delivers tax cuts, but higher bond issuance. And we look at why the Reserve Bank in New Zealand might be concerned about that. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Pacific economist Kishti explains why he believes Fiji has a 3-speed economy.
The pent-up international travel demand in key markets and advanced readiness for open borders with careful and detailed planning put Fiji in a prime position to return its tourism industry to pre-pandemic output.
But first, in 5 and 5 with ANZ, global markets were pensive overnight ahead of US personal consumption expenditure inflation data. That's the PCE data. That's due later tonight. It's the Fed's preferred measure of inflation. In bond markets, yields retraced from their highs after this week's big sell-off that saw the 2-year hit 5% briefly on Wednesday. The US 2-year Treasury yield fell 6 basis points overnight to 4.92%, while the 10-year Treasury yield fell 7 basis points to 4.54%. That meant the US dollar weakened against the Aussie, the Kiwi, the Euro and the Yen. As of 5 a.m. Sydney-Melbourne time, the Aussie dollar was up 0.5% at 66.41 US cents. And the Kiwi was up 0.3% at 61.3 US cents. ANZ economist Bansi Madhavani says markets really are focused on the PCE data tonight.
It is a PCE data that will test markets pricing and FOMC's resolve of higher for longer stance. Now earlier, Fed Vice Chairman Jefferson said that staff estimates suggest core PCE rose at an annualized rate of 4.1% in April-January period. That would imply that April core PCE rose at 0.25 to 0.26% on a month-on-month basis. If the data are in line with these estimates, it would be the slowest rise this year, and it would also indicate that the improvement in inflation towards target is intact.
Number 2, the first budget of the new government in New Zealand delivered widely expected income tax cuts, funded by lower government operating spending. And while the government stressed this could be disinflationary, as some people might save their windfalls, ANZ senior economist Miles Workman says adding in a lift in capital expenditure has created some inflationary risks for the Reserve Bank.
If you really zoom in and ask the question about what does this all mean in terms of near-term CPI inflation risks, 31 July is quite a near-term bump to household incomes, and the Reserve Bank will be a little bit concerned about how much that will add to aggregate demand pressures at a time when inflation is still well above the target level. So you have to put this into context. If we're talking averages over the forecast horizon, well, that's one thing. But in terms of what the Reserve Bank really care about, is they care about their current inflation problem. Their inflation problem is a 2024, 2025 story, potentially, but this sort of front-loading of the tax cuts is something that will get their ears pricked up a little bit.
Number 3, on the fiscal side, a return to surplus has been pushed out a year to 2027-28. Alongside the deterioration in Treasury's economic forecasts, that has seen the New Zealand Debt Management Office lift its bond program by $12 billion over the next 4 years. That's compared to what it forecast in December. Here's Miles.
They have also given their short-term issuance a medium bump. So this is things like Treasury bills and ECP. For the current fiscal year, they expect that one to end at $18 billion versus their high-EFU guidance of $9 billion. So in big picture terms, there is a meaningful uplift in overall issuance from New Zealand Debt Management. On the bond supply side, it's quite similar to what we were expecting. We had penciled in a $10 billion increase and we got a $12 billion increase. But yes, there is certainly more pressure here on debt issuance going forward.
Number 4. So as mentioned, the US PCE inflation data for April is due tonight. It will be the last major data point ahead of the FOMC meeting on June the 11th and 12th. Here's Bunzi again with the detail.
The PCE deflator is expected to soften, with headline and core growing at 0.3 and 0.2% on a month-on-month basis, respectively. The sharp decline in airfares is likely to be the main driver of this fall. A confirmation that disinflation trend is intact will provide confidence to the FOMC that the economy is slowly rebalancing after a bumpy first quarter.
Number 5. We get India's first quarter GDP figures tonight. GDP is expected to grow 6.2% from a year ago, according to the consensus. ANZ economist Diraj Nim writes he's expecting a 7% rise for the year, driven by construction investment, before tapering off later in the year. Now, in our bonus deep dive interview, ANZ Pacific economist Kishti details why he thinks the island nation has a 3-speed economy.
You have the industries in the fast lane, if you want to call it that. And these are your accommodation and food services industry, your transport industry, airline that flies tourists in and out of the country, and the administrative and support services sector, because that's where the car rental hiring, tour operators, and travel agency providers live. And the reason why these industries are doing better than the rest is because of the swift rebound in international tourism. Now, visitor arrivals in 2022 exceeded most expectations, and last year, inbound demand surged past the record arrivals of 2019. So essentially, the pent-up international travel demand in key markets and advanced readiness for open borders with careful and detailed planning put Fiji in a prime position to return its tourism industry to pre-pandemic output.
And what's in that middle lane?
Those that depend on consumer demand, such as your wholesale and retail trade industries, your information and communication businesses. And I would sort of put manufacturing there in as well. So sales or output of these industries is supported by what I call your family bank. And by that, I mean money that is sent from friends and families working abroad, which in recent years has really taken off due to employment opportunities provided in both Australia and New Zealand. Now, the Pacific has a very stronger together culture. We're looking after each other for budget support. It's a fairly common practice. So the private money transfers into Fiji are characterized as remittances, or the family bank, as I've described it, has hit a purple patch and gone past $1 billion mark.
And in the slow lane, who's in that at the moment?
Okay, so in the slow lane, we have industries that depend on large-scale investments, whether it is a construction of residential dwellings, warehouses, your commercial and retail buildings, hospitals, factories, stadiums, industrial parks, transport and utilities infrastructure, or your hotels. Now, and these industries that depend on large-scale investment are your business service sectors, such as your professional and technical services firms, your real estate service providers, as well as your finance and insurance businesses. So as new investments have been slow to come through for Fiji, the business service industry sectors have really stalled. And these are the ones in the slow lane. But having said that, I remain optimistic. These industries in the slow lane can change lanes over the next 2 to 3 years, because Fiji really has a solid project pipeline.
Fiji's obviously rebounded from the pandemic, but what's its prospects in the next year or two?
So the next year or two, basically we see Fiji returning to its pre-pandemic routine, where the GDP of the country grows by about 3% per year. You still have positive growth rate. Tourism industries do not just fall off a cliff. They will still grow, but not as solidly as in the past 2 years, because it is at capacity accommodation-wise. Now, new capacity is under construction, but it will be towards the back end of this decade, we believe, before tourism returns as the key growth employment driver. So there are some of the other industry sectors which will contribute to Fiji's GDP prospects over the next 2 to 3 years. You've got a new Tuvalu gold mine coming up, and that's expected to ramp up production this year. That will help. And the agriculture sector, of course, has been the steady hand at the tiller, which has delivered about 0.5 percentage points to GDP consistently. So overall, I think over the next 2 to 3 years, we come back to a situation where the country actually returns to its long-term historical growth rates of about 3% per year.
Kishti Sen there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, May the 31st. Catch you next week with a reaction to the US PCE data and Euro area CPI inflation data tonight, as we look ahead to the Fed's big meeting. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.